All right, everyone. Welcome to the Hurley Investments Market View Commentary for Monday, the 23rd of September. This year just keeps flying on by. Where I want to go with this week are seasonal or cycle trends that I use in making investment decisions. So we have a couple. If I was going to start in January, work me through some of the seasonal trends. What are some of the seasonal trends that we go through? Not much happens in January, right? But February, we tend to have a sell-off, and I kind of call it a Christmas hangover. It just happens that way all the time. Ooh, nice, Mod. We have an April fund shift due to taxes. That's usually a flat month, but a sell in May and go away. September and October are usually down months. And a Christmas rally after after Thanksgiving. That's not true. It's Black Friday. After Black Friday, right? Until Christmas. Yet last year, the 24th, was the typical quote unquote I think it's on the 24th was the start of a Christmas rally last year, was the bottom. And then the Christmas rally went through. Now we have some other ones, some that are cycle trends that are more on a monthly basis. Monthly basis, I liked what Maud said. Maud, you nailed it all last week. We usually have pre-earnings, run-ups. I completely agree with that. Post-earnings, depressions. We have option expiration, right? Where, in fact, I'm going to make another one. I'm going to put another one. Where up months are usually sell-offs on options, and down months are usually run up on options expiration day. So on your monthlies, if you have a down month, there are a lot of people that do their short covering on their options for their short calls. On up months, usually people are selling out, and the sell-offs usually occur on the up months on the options week for the monthlies, and on the down months, it's on the options day. What if I said, what happens the Monday after options expiration? What usually happens there? Today was one of them. But what usually happens? Anyone have an idea? What usually happens on days like today? I gave you an example. Today was one of those days, right? There we go. Perfect. Usually after options, so the Monday after the options, I should put in there again monthly options. We have a buyback in Monday where people are buying back into their options, buying back into their stocks. And today is an excellent day that gives an explanation of that. Here we have, in all honesty, a pretty poor sending troops to the Middle East. We have a definite Iran is the culprit from Saudi Arabia. By all intents and purposes, today should have been a pretty down day in the market by world sentiment. But the U.S. kind of bucked that. If we take a quick peek, although I might have missed it already, I'm pretty sure Europe wasn't doing particularly well. Asian stocks were lower. The EU was lower. So pretty neat to see the U.S. buck a trend. To give you a heads up, at the end of each week, I do a weekly review. And it usually starts Monday morning where I get my Y charts update is the best way to say it. This comes out Monday morning. I'm usually doing my recap and saying, all right, let's take a quick peek at what's happened last week and where I fit in. Last week, the three major indexes moved lower as the S&P 500 was down 0.51%. So I already knew at the end of last week, I was down 0.61%. So I'm in range with the S&P 500. The NASDAQ fell 0.72, the Dow fell 0.01. So I beat those two, but my benchmark is the S&P 500. So I was pretty close. Only 4 of the 11 sectors ended the week higher, with utilities being the highest and consumer discretionary being the lowest, which helps me understand where my portfolios are fitting in. Internationally, developed markets slid 0.58. Emerging markets were down 0.51. Main important thing, the Fed lowered the target rate to 1.75, the 2.0 range, and the 10-year to 2-year Treasury yield spread narrowed to 0.015. So I'm in line. I like what I see. I was okay with the way things happened last week. I then go to some of my core stock holdings, and I just do a little recap. I take a peek at it. Zions Bank was fighting all last week to get above the 200-day. We had a pretty low open today, bounced back, created a doji. Usually says I'm going to go higher there. I can sit back and be okay where Zions Bank is a core holding. Visa. As I looked at Visa, I was worried on Friday, but it still is in that 72.5 to 77 range. It actually held the 73.81, 74.24, 72.91. We seem to have that lower base there that I'm not ready yet to put long puts on Visa, but I'm very, very close. I was hoping for more of an up day, and I would have felt a little bit better if Visa was 9 cents higher, recapturing 175. I'm going backwards because of the way I did everything. Under Armour. Under Armour, I have long put protection on because it broke 20. I'm glad to see that it's below 20. And I also have long put protection on a little bit early on Under Armour because Nike reports tomorrow. A good Nike's report usually sinks Under Armour down. I still think we'll hit 1750-ish. Four will recapture 2156. Will probably push Under Armour lower. That is why I already have long puts in place on Under Armour. Facebook. Facebook is fighting for the 50-day. I do not have long put protection on Facebook just yet. It also seems to hold the 85. I'm seeing if we're going to get one of those pre-earnings runs. I know there has been some pretty horrible news on Facebook through the month of September, but it's held in very well from the 191 range down to 186.82. It started the month out closer to 184. So a lot of people ask me, Kevin, why the hell aren't you putting protection on Facebook? Well, look at a chart. It's in its predefined range. It's ranging $4 on a $186 stock. Let your stock move. It's hard to do. It's extremely hard to do on some positions. But it's the way I've chosen to not waste 3 weeks of expensive long put protection. Off I go. I let it sit the way it is. Ford. Freaking Ford. Right on down, came down pretty quickly below its 50. Usually it goes down and bounces right back up. We're right there at that bounce point at, should be still around 916. Closed at 916. Perfect. So I'm just looking for the bounce. Well, Kevin, couldn't you have put 950 protection on? Yes, I could have, but right now we're dealing with 939, which was the bounce below. And from 939 to 905, I'm willing to let the stock run 25 cents. We're actually higher than we were on the first day of September. We have a tightening, or you could say a pennant forming. We're going to get a breakout one way or the other. I'm loving what's happening to General Motors. Chrysler with their new Jeep truck looks really cool, but high price, not really selling, or kind of priced themselves out of the middle America range. So I can let the breakout occur. Most likely it should occur to the high side on Ford. Disney, freaking Disney. Disney is one I feel I may have missed a little bit. I probably should have put 140 put protection on in place. But when we finished our last month, we were in that 135 range when the last monthlies, ended. And we had ours out towards the last week. And boy, that just moved. It just moved. We had one big down day. Actually, there were two big down days on news. One was Apple, and the stock actually went up on Apple news. One was on what am I trying to tell you? On Comcast. I probably should have protected at 135, but I'm looking if I have to, if I get one more down day, I'm just going to have to put on the 132.50s on an odd week and run it down to the 125. Disney's the one I feel I probably could have managed better. Baidu, we had some puts triggered at 107. It was the preemptive drop on the downside for breaking the 50-day. So we had 107 puts initiated on Baidu. And there's a question I missed. I'm going to go back up to Disney. Am I worried about Disney filling the gap? And I'm not. I'm not, because we have the 200-day there, and because we should have an earnings, and their earnings is placed after they start their Disney Plus service. So, am I fearful they're going to go all the way back to 117.50? No. In fact, if anything, I think their next earnings will push them above 150. That's going to come 7 or 8 days into their November. Usually it's the 7th or 8th that they have their earnings on. So if they can say they got a couple million people that join their Disney Plus service, I will be one of them in their first week. I think it only propels them higher. I also would expect the 200-day at 125 to be in place, and really they have a 127 and a 130 horizontal level of support. So I really think worst comes to worst, they go from 132 down to 125. They might go from 132.46 down to 130, or most likely they'll go back and they'll test the 50-day simple moving average, which I'd like to much rather protect at 137.50 on an odd week, like the second week of November, something like that. All right. Baidu I went through. Boeing, I've got a couple people in Boeing. I love the price action today. In fact, can someone tell me really quickly what we see in today's price action? Someone tell me what that is. That's a doji, which would mean a reversal. Well, let's take a look at the last one we had. Right there, pretty big bounce up, but that was because it was on the 200. A more realistic one was right here, pretty big bounce up. My 360s expired on Friday. Little disappointing to see the movement today, but the movement or the selling today was on pretty low volume. So I can sit on Boeing for another day. Worst comes to worst, I will use 175 as my level to add my protection on. I like how 177 was resistance there. 177 to 370 support in there. You also find some support here. So I can let some things go. Still technically bullish. And if you had your 5 and your 20, you would see that you're still technically bullish on Boeing. So it's one that I can sit on just for a bit to see if we'll get that bounce higher on Boeing. Bank of America. We protected through the rate announcement. In doing so, when it got below 30, excuse me, when Bank of America got below 30, it triggered the puts. They are in place, and I'm fearful we'll see Bank of America go all the way down to 28.49, even though we shouldn't. It did have some buying activity in it today. But here's one on knowing your stock. Drop below 30, triggered $30 protective puts when it hit $29.95. We look kind of brilliant in having our long put protection on Boeing. Excuse me, on Bank of America. And last but not least, Apple. Like the doji, saw the down day and the flush on Friday, held a support level at 217.50. Nice bounce off of it today. We're still a little bit ways out. Apple earnings are usually the last week of October. So again, I'm trying to buy us some time to see if we can't get a little bit of good news to bounce higher on Apple. But this is my end of the week review. And again, it just not saying that it's not saying that it's exactly the same every week, but my end of the weekly review is over the indexes and core portfolio positions. And I have to make my best educated guess on where we're going to see some things head. I would expect us to go down this week. Why would I expect us to go down this week? Someone please tell me, why would I expect us to go down this week? What would cause me to think we're going to go down? Geopolitical risks? Yeah, but I would have thought that already happened. But it's the end of the month. What month is it, Maud? Why would I say end of the month? You are correct, but why would I say the end of the month? September to remember. It's a quarter. It's a political quarter, end of a quarter. So that's where you're going to see some funds reposition. Sometimes you also see it reposition on October government contracts that end. But the reality is it's the end of a quarter. And so usually at the end of the quarter, you might see some funds rebalance. You don't see a big rebalancing though in September because they're already positioned for a Christmas rally run, but you never know. This is the one quarter that's most suspect that you typically can't say, hey, here you go, you're off to the races. A sell in May go away usually makes your June quarter down and some end of the quarter sell off there. You usually see some gains that first quarter though, and I think that comes down to repositioning for taking some money out for taxes there in March. Dow Jones Industrial Average, still technically bullish, but we're kind of floating sideways. S&P, still technically bullish, but we're floating sideways. NASDAQ, still technically bullish, but floating more sideways and closer to being negative or bearish. End of September, where is it going to end? I still think we're going to be down 1%. If you take a look at the S&P chart, though, to put that into perspective, am I going to be right? $29.10-ish is where we started the month. Probably going to end it closer to $29.50-ish. So in all honesty, 10, 40 points, we actually are probably going to be up for September overall. We're probably going to be up a positive 1.25. But that's still down a little bit from where we are today. Earnings. AutoZone, CarMax, JBL, Nike's the big one on Tuesday. Fuller and KB Homes on Wednesday. Conagra, Micron, Mountain is the Veil, Carnival Cruise Lines on Thursday. No real market movers, but I will be paying attention to Nike. I will be paying blah, 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 blah. I will be paying attention to Fuller and KB Homes on Wednesday, just to see how they did over their more profitable season during summer. And then obviously Thursday, I'll be paying attention to Micron. Economic reports. Everything really comes down to Thursday. GDP numbers will be big. If we can beat by 2.1 instead of a 2.0, you should see our markets move pretty dramatically Thursday. Friday, personal income, personal spending, durable goods. If those are able to beat, and durable goods is at a negative 1.0, durable X transportation is at 0.2. If we can beat on either one of those, personal income is 0.4. We'll say the same if personal spending comes in at 0.4 instead of 0.3. We'll have some pretty good up days there. I saw nothing internationally that works. Nothing internationally that causes me any worry. Not that it works, but nothing that stood out to me. There is a Germany industrial production number that I might pay attention to. I found a big picture from briefing that I thought was pretty good. I just want you to read it. And really what it comes down to is the S&P 500, even though it's up, we're doing so on lower year-over-year earnings each quarter. So there's a precursor for your recession. And I like the way this was written. I like the way briefings.com wrote the big picture for last week, because they listed out the wall of worry. They listed out the things that we need to pay attention to. They listed out both sides of the fence. But it's a very interesting article, and I would suggest you read through most of it. But it puts into perspective why it might be on the side to start to overprotect going into this earnings than maybe not giving enough protection. It also shows that some of the IPOs haven't done particularly well. Well, Kevin, it looks like they're all up from where they are, which is true. But when your momentum stops, you could be in some pretty big trouble. Anyway, I'm just going to suggest you read through it. Warren Buffett has kept the same investing philosophy for decades. Early interview shows. Again, if anyone was to ask me, in fact, I put this article in here in all honesty, because way back when someone called me a stock jockey. Kind of pissed me off at the time, right? Oh, you're just a stock jockey. And I asked him what he was doing, and he had some algorithm and some artificial intelligence, and I kind of giggled at this guy. And yeah, you know what? He did have more money under management than I did. But to put it in plain English, this guy didn't know a damn thing and couldn't tell his head from a hole in a horse's ass. He was an idiot. His son was even dumber. And I got to be honest with you, for people that honestly think that's a professional in my industry, that there is some algorithm that predicts the future, that because you have a stock screener that can screen 10,000 stocks in a day, that somehow you're going to call that artificial intelligence. I just had to scratch my head because in real life, there's not an algorithm that predicts the future. There's not artificial intelligence. It's really just a stock screener that predicts the future. And for a professional to fall into that sales pitch line and actually believe it, I just had to scratch my head and say, you know what? You're an idiot. If there really was something, let's put this into common sense. If there really was something, don't you think JP Morgan would have bought it for a couple $1 billion for the $1 trillion they have invested so that they could use it, make it proprietary, and make a killing all the time? It's ridiculous. It's stupid. It really bothered me, and it probably set me off. If you talk to Keeve, I was probably pissed off for about 3 months. But when it comes down to it, in my opinion, I've always thought Warren Buffett was the best pure investor that's ever lived. And really, it comes down to finding stocks that are beat up that have a huge upside potential. So some people ask me, well, Kevin, you dummy, why are you still in Ford? Why haven't you given up on Ford or Bank of America or Under Armour? Why are you keep adding shares? Well, I'll be 100% honest with you. Because I got caught on the backside of NVIDIA and the damn thing shot off and I had it capped. It was impossible to buy back the short call when it goes up 40% on its earnings report. Because on Boeing way back then, when I got talked out of sitting in Boeing, when we almost doubled our shares, so of course I finally sold out at $80 a share. When Boeing now sits on a bad year at $377. I'm sitting in some undervalued positions adding shares like AOBC or FCX because eventually they're going to pop and move dramatically. And if I can add 1,000 shares and they have a 50% pop, it'll be like a 200% return for my clientele. You don't need tons of IQ to be in this business. You just have to stick to your plan and be smart about how you invest other people's money or your money for that matter. It's simple to understand and do. So there I'm off my my soapbox. It's why we will not use some dumber than dirt algorithm or some artificial intelligence. It's nothing more than a stock screener. We don't push those on our clientele. We don't blame those on decisions when they don't come to pass. We don't sell you on something that's not true. We're straight to the point and say, you know what? We're doing our own numbers, working our own numbers, finding the best undervalued stocks with the most upside potential. You've heard me say a couple times this past week, maybe I've been a little confused, or I've made a couple comments on maybe I don't know where things are going, so I have to sit on my hands. Very interesting article on Saturday that after options expiration, I was like, this looks pretty interesting. And the numbers were able to be validated for me. The stock market rotation that shocked investors this month may have been driven by a technicality. Rocked, excuse me. The reversal momentum, which seemed to abate this week, could be explained by a sudden stop in tax loss harvesting, some on Wall Street said. It's a little early to be doing tax losses. Normally you'll see that, that last week of December. Another cycle, right? Last week of December is usually tax selling. But maybe because we might have a Trump administration that will reduce capital gains taxes, maybe we're going to have a China big run in. It seems like there's some that have been taking some tax losses this year and selling some positions out. What happened during the once-in-a-decade stock market rotation earlier this month that rocked investors? It might have just been a one-off technical move, not based on fundamentals. There was a huge rotation out of momentum-based stocks, which for me justifies or explains what's happened this month, where a couple times I really had to tell you, I'm not sure what's going on. I haven't figured it out yet. This seems to be my explanation right here. So I'm going to take it for what it's worth and say, you know what? Spend some time reading the stock market rotation. It makes a lot of sense. And their numbers seem to validate it. I found it very interesting on Saturday. 50% of Americans are considered middle class. Here's how much money they earn. I have a household of 8. So on the low side, it's probably somewhere in that $80,000 range. On the high side, it's most likely in that 250-ish range, probably 249, right? So I fit into the middle class, more smack dab in the middle there. I guess I'm middle class, but I just found some interesting numbers where it seems to me that we have a bigger middle class than I can remember having in the past. Pretty interesting article. I just found interesting to me. I have a couple in regards to bear markets or a recession. For anyone that's done any research or studying, David Rosenberg is the definite perma bear, right? The market always sucks for this guy. It's always there's a recession coming. He blew it last year. He blew it the year before. Obviously, there's always a recession coming when you're getting out of one. It's a matter of time. There have been some indicators that have predicted a recession in the last 2 years that have not been correct. The biggest one is most likely our inverted yield curve, which says there's a recession in the next 13 to like 26 months, right? So the recession that we're looking at is most likely due to the fact that we're having negative earnings year over year on these S&P 500 companies. That's where it's going to come from. I'm sitting here going through this, and I'm thinking there are a couple positives that could happen that could still move our market higher. In this bull run, I think you could probably go through and say you've had 4 years of negative year-over-year earnings, yet we still ended up for the year. So this historic bull run is different than all the others. And the fact that you have negative year-over-year S&P 500 earnings, yet your stock market is still going higher. I would probably suggest that comes from the tailwinds of QE, the tailwinds of companies buying their own stocks back that mask what would have been a typical correction of 20% or more. Correction is 10%, a bear market, which is 20% or more. Our one correction, we're in it for a day, and we were out of it again. I think it's just different, is all I'm going to tell you. Once again, we have a once-in-a-lifetime, first time ever, where you have a 10-year plus bull market, and we have 4 of those 10 years on negative year-over-year S&P 500 earnings. Typically, that is a 6-month precursor. Your recessions comes within 6 months from there. Ron Paul, U.S. interest rates are going negative. The Fed can't stop it. Again, this is just a run on fixed income. Really, if you're in a bond fund, I got to scratch my head and say, you know, what the hell are you doing? It just doesn't make sense to be in the risk is too high with the potential of negative interest rates, with interest rates haven't bounced back as they should have, it's just too high to be in fixed income right now. He calls it the biggest bond bubble in U.S. history, and he's 100% correct. And it's going to be ugly when it resets itself. Here we go. I thought it was pretty interesting. Jim Cramer reveals quick and dirty Wall Street tricks for buying cloud stocks. It was just something that I saw that I thought might be interesting for you guys to read. Trello, Adobe, New Relic, there's some I haven't even heard of. Just take a listen and look through it. And last but not least, the dollar shortage and liquidity crisis. This is Martin Armstrong. Please understand his, how would I say it? His stuff is always a scare tactic. When it comes from Martin Armstrong, it's always a scare tactic. It's always the worst case scenario. It's always watch out below. But I decided to keep this one in here because it matches an article that I saw a couple of weeks ago. It just really comes down again to dollars going out there. I did find it interesting that he says, with the rising pressure outside the U.S. to eliminate cash in order to confiscate money from their citizens to support a broadening collapse of socialism, there has been a major panic pushing into the dollar. I disagree. I completely disagree. I do think we're pushing a large amount of dollars out there where the supply is on the high side, so it's keeping inflation down. That is what I'm going to tell you. But if you want a good scare tactic with some keywords like socialism and foreign holdings and U.S. debt, I would tell you his whole premise for negative interest rates and for a weakening dollar is off, but the results that could happen from them are pretty easy to see. I wanted to throw it in here just so you could read a little bit about what some people are saying so you can see some of the risks that are there. I would not give a whole lot of credence to Martin Armstrong. The reasons why it is going to be a problem, I think, are off, but it still is a problem that we should be paying attention to. With that said, any questions tonight? Any questions that I can answer for you tonight that might be helpful for the group? Let me give you 10 seconds to figure out a question, unless you're Lance. Of course you've got a question. Kevin, if you think Martin Armstrong is crap, I did not say that, then why are you reading it? So, Lance, to keep it simple, a lot of what my job entails is to read a ton of articles. You know, I get up at, most of the days, it's between 5:45 and 6 o'clock. And I got to get my daughter up for taking her to gymnastics. It's my little time that I get to spend in a half-hour driving there, a half-hour back. I listen to CNBC, Fox News, but I spend a good half-hour reading. When I get back, I usually don't want to do a trade that first hour, so I spend that first hour reading. It's my job to read everything that's out there and to check the numbers. I check the numbers after I read everything that's out there to find out what's crap and what's not. Once I found out the crap and sift through it, I'm then prepared. If you were to give me a call, send me an email, I'm then prepared to say, hey, this is crap, this is why. It's my job to read it before you do. I love some of you guys that send some stuff to you, hey, in case you haven't seen it. Because I'm going to tell you 99 out of 100 times I've already seen it. but I'm grateful that you guys will send me something like that so that if I haven't, I don't get caught off guard. With that said, and I believe he's here today. He is here today. Someone asked me today, Kevin, why the hell did you sell off my monster? And I actually had a client that wants me to do a little more of my spread trades in his account. And I got caught off guard. I ended up selling his shares with my past holding group from Monster, and he wasn't part of the, hey, we did a bull put, but instead of holding on to it and putting on a covered call, we're just going to look to get back into Monster at earnings. And I forgot I had a dangling 500 shares out there. So he's kind of, well, not pissed off, but he's like, you sold it for a loss. You're out of it. You let a long put exercise my stock away from me. I tried to say, well, yeah, because we had a 65, 63 bull put in place. Well, that's not me. Okay, then you're my original group. And if you look at the 2 previous earnings, we did pretty good. He's like, Kevin, you just put this on at the beginning of August. And I was like, let me look into that. So occasionally I'll look into something where I have to say, hey, I grouped into everyone else, but we're going to get back into it. Just give it a little bit of time to prep for earnings so I can get back into Monster. But yes, there are times when I might miss or group someone into something differently. So the reason why I read everything, even the crap that's out there, to make sure the crap is still crap, to make sure the good stuff is still good stuff, so that I can read it, work the numbers. It keeps me on my toes to make sure people aren't peddling BS out there. If they're close, I can agree with it. If they're not close, I want to know before you call me and I have to justify something or say, hey, have you checked those numbers? Have you read those numbers? So that's why I do it. I subscribe to a lot of stuff. Probably 75% of it is crap. But if I don't do my job and check the numbers and validate it, then I'm not, then I got to be able to admit to you, hey, I don't know. And I should know. If I'm doing my job, I should spend the time to figure it out so I'm aware of it before you bring it to my attention. Lance, hope that answers your question. If not, give it to me again. Any other questions out there? I've got a couple thanks, Kevin, and a thank you. Caller trading. Kevin, why does caller trading take so long? So here's the correct answer there. There are 3 problems with caller trading. Number 1, not putting your protection on at the right place. If you're overpaying for protection or you're putting it on just before earnings in the month of options expiration at a shorter term, not pushing you outside of volatility crush, you're going to lose money caller trading. You'll always lose money on your puts, and it eats up too much of your profit. Number 1 problem with caller trading. Number 2 problem with caller trading, having a stock that's not volatile enough. And there's some that maybe have fit into that here recently, but still have that upside potential. Disney, Ford, Bank of America, yes, they haven't moved enough yet, but they still are in that higher volatility, can move campground. Just because you call or trade does not mean you should be in pharmaceuticals and biopharma and purely speculative techs crap. You're looking to be in good companies that are undervalued, that have a great opportunity to run. Hence, that's why we're in a lot of stocks that Buffett may be in. No, we're not going to jump into Kraft Heinz. That's Buffett's biggest screw up. He admits it, but again, they didn't give him all the information when he jumped in there. So just some things to keep in mind. And last but not least, a caller trade will not work if you don't have the patience or the guts to let the stock run at times. I talked about overprotection. If you always have it capped and you always have protection on, you can't be profitable in a collar trade. It just doesn't work for you. You get capped out, you get in trouble, and then you're in trouble. With that said, there are times when you got to have the inner fortitude to let your stock run. If the stock is bullish, with all due respect, you're an idiot to have and be rolling long put protection up. You're giving away your profits. You shouldn't be doing that. You should be letting your stocks run. I might ask you, why are you putting bearish positions on bullish running stocks? Because I don't understand it. With that said, I collar trade because I want to protect my money. I collar trade because it allows me to be wrong. And when I can be wrong yet still make a profit, I am a happy camper. I'm looking at the pre-market right now. The Dow's up 109, S&P's up 11.75, NASDAQ's up 36. We might see a nice run into tomorrow. I know how would I say this? I know that the futures right now don't mean anything for tomorrow, but for Mnuchin to say that he canceled the China farm tour, a little shocking. I wonder if they're covering up on something or not. But I like where our futures are at today. If we can get some follow through tomorrow, we'll be in good shape. Guys, have a wonderful evening. I appreciate you being here with me. I will get this posted here tonight, and I look forward to talking to you tomorrow night if you can attend that trade findings and adjustments. Have a wonderful week otherwise, and I will see you next Monday. Good night, everyone. Bye-bye.